So today we're going to be going over VIX, SVIX, and then how to trade 10-minute and 30-minute flags properly. So, VIX at 12:15 a.m. this morning, it gapped up to 35. This is a major key resistance point on the VIX, and I had a limit order for SVIX for 16, and I got filled at the bottom of this candle, and then took it all the way up to 1840. Made a nice little, I think it was, what percent is that? It's like 12%. Yeah, made a nice 12% on it. But if you look at the VIX futures as well, because SVIX is shorting the VIX futures. So if you look at the VIX at the beginning, so I placed the limit order because it was rejecting 30 last night. So I placed the limit order for 16 to get filled in the extended hours, the pre-market session on SVIX, because it was rejecting the 30 level on the futures, which is what you're shorting with SVIX futures ETF. But yeah, every single time that VIX, I took this every single day for the past week. VIX gapped up to 25, took SVIX, shorted it down, got a nice 3%. Came up to 28, bought some SVIX, shorted it down for a nice 4%. Gapped up to 25, rejected 25, made a nice 2% on SVIX. Here also rejected 25, made a nice 1.5%. And then here, I took it off of 30 and made 5% on it. It came down quite a bit, and then at the end of the day, it came back up to 30. And then today, gapped up to 35, got the SVIX, made 12% on it all the way down. But yeah, if you look at 17, 18, 20, 22, 25, 28, 30, 32, and 35, all of these are very, very important spots on VIX. And if you look at the market, if you look at the indexes on these days where it's breaking through key levels, you'll see what the market does. I'm not going to go into it right now, but you can backtest it yourself. Like here, it breaks through 17, 18, 20, 22. And if you want to go back and look what happened on December 17th, I'll just go to the market real quick. Fell off a cliff. Yeah, I just recently started in SVIX. Alright, so that's how I've been playing VIX. And the reason why VIX is not good, or it's not good to trade options when VIX is super high, is because, so if you know about market makers, let's say you got market makers, and these are classified by like hedge funds, banks, big money, etc. So they are the options sellers. So they're the people that put options up on the market. They're the ones selling the options and making them available. So let's say we have SPX today, and there's an entire wall of 660 puts for, let's just say $2, because VIX is high. They're going to do everything in their power not to let it get to 660, because if they do, then they're obligated to sell you that because of the option contract. So let's say you have the 660 put, and then price goes to 58. The market maker has to sell you, or they have to buy it from you for $660 per share, even though price is at 658 because of the option contract. The strike price is what they're obligated to sell it for or buy it for. Like even if it went all the way down to 640, you can sell it to them for 660 if you own that option contract. That's what options are. And the reason they sell it is because 99% of options contracts, especially on 0DT, expire worthless. And if you look at the volume on SPY for 660s, there was an open interest of 20,000. And what did they start out at? They started the day off at $1.25. So if you have $1.25 per contract and there's 20,000 of them, what is that? That's $125 times 20,000. That's 2.5 million options that just $2.5 million worth of options that just went to dust, and they collected the premium off of it by not letting it get past 660. And that's why you'll see on OPEX on Fridays where there's OPEX. Let's go here. I'm going a little off topic, but I think it's important for everybody to know. Let's say there's a bunch of 680 puts, they're not going to let it get down there. There's a bunch of 690 puts, they're not going to let it get up there. And it closed in between the 690 and 689. So they're making every single call past 689 expire worthless. They're making every single put past 689 completely worthless as well. Just collecting the premium. So if you guys look at VIX, when there's a lot of fear in the market and volatility is super high, yeah, OPEX is every third Friday. So when volatility is super high, that means that there's a large expected move. And going back to something Jeffrey said, when the volatility is above 32, the implied move on SPY is about 2.5%. So that's why when the volatility is super high, there's a big move. So the options sellers have to hedge for that by increasing the premium. That's why whenever VIX is super high, the premium costs a lot more. Like contracts that are normally worth $60 a piece are now worth $300 a piece because they have to compensate for that expected move that's larger than normal. Does that make sense? Did I explain that okay? All right, cool. Yeah, I'll have to look into that. But yeah, you can mark these levels out 17, 18, 20, etc. and look back and see what happens when these levels reject and when they get broken. I don't have any marks up here because it hardly ever gets that high. And when it does get that high, there's not really any point in trading. But yeah, you can see how price reacts or how VIX reacts to these levels. All right, but now we're going to go to 30-minute flags. So AVGO today. If you look at the 30, makes this big move up, comes down, taps the 80 EMA. And normally this isn't a super good take because you get this bearish engulfing candle, but buyers come up off the 80 EMA. And if you look at a 10-minute, price is pretty clean. Clean candles, not a lot of wicks. It's clearly a fade down into the 20. And once the 20 bounces, you get that little entry right there. Stop is at the bottom of the candles, probably slightly below if you're playing 0 DTE. And then 4.6R, 100% on that, Haley got. And then yeah, when you see full body candles like this and prices in a clear direction down and it's not like up, down, up, down, up, down, that's when it's a good flag. And then another example is Amazon on last Wednesday. If you look here, it's a clear trend down to the daily 20, or down to the 10-minute 20, which is the same as the 30-minute 8. You get that entry off there once it starts bouncing, and then put your stop at the bottom of the candle or slightly below the 20 EMA, and then you let it work. These ones went 200%. And then another example, I'll actually go over this 10-minute flag here. So it's a clean 10-minute flag. You go to the 3-minute, super clean as well. And it starts getting bounced off the 20 right there. So there's your entry. This is just one of the times it doesn't work out, but you want to take this every time. And then it ends up failing, but most of the time when it looks like that, it's going to work. No setup is 100%. But yeah. Even then, it's still almost a 3R trade. If you're taking it on that bounce and then putting stop below the candles, 3R at the top. Where would I cut that trade? Below the 3-minute 8. Or just set your stop at break even. But then once that fails and you get nice clean price action on the 10-minute, bounce off the 20, and you let it go. Yeah, I enter 10-minute flags on the 3-minute, because if the 3-minute isn't super clean, the 10-minute isn't likely to work out. It can work out, but it's not as good. And then another example is Meta on the 25th. Where's Meta? All right, so we get this big impulse move, get over the daily 8 EMA, comes down, nice price action, getting bought up, taps the 8 EMA on the 30, comes back. And then if you look at this, it looks the exact same as Amazon. Super nice clean price action, get that big impulse move, comes down, taps a 20 EMA, gets bought up, boom. This is exactly what you want to see when you're trading 30-minute flags. And then right here, if you go to the 3-minute, it is also, I mean, it's not super clean, but it's a clear direction. It's a clear fade down into the 20. So you also want to take this, but it'll fail sometimes, which happens. And then that's when you look for the 30-minute flag instead, right there. But yeah, that's all I wanted to go over today, was trading the VIX and what to look for when trading the different types of flags, the 10-minute, 30-minute flags. You want to see clean price action into the 20 for the lower time frames. Yeah, you don't want to see a rainbow. You don't want to see it curving up like that. You want to see it get that impulse move and then fit down to the 20 and then bounce. You don't want to see it have that curve. That curve is a signal of momentum failure. Because it's not having clear sellers, it's not having clear buyers. It's kind of just there. Yeah, I'm gonna end the recording here and post it on YouTube.